Good morning, ladies and gentlemen. My name is Dereck Blair. I'm president and founder of Caprock Financial Group, and you're listening to Caprock Wealth and Wellness, the Caprock Blueprint to a richer, more balanced life. And thank you all so much for taking the time to join us. Looks like it's going to be a beautiful Saturday here in Lubbock, Texas, and I hope you make it a great day and everyone has a good one. So again, thanks for joining us. And so I wanted to talk a couple of things today about advice, just overall advice when it comes to financial matters, when it comes to financial planning, what kind of advice is out there. But before we jump into that, I want to jump into top issues concerning Americans in 2025. So this was one of those deals I kind of got down a rabbit hole, started Googling some different information. And so a couple of the charts that I found very, very interesting with all the things going on in the world and all the things that are happening, whether it's war, whether it's tariffs, politics, anything like that. This was a top issues concerning Americans in 2025, and number one at the very top was inflation and cost of living. Now that really surprised me because what it said was inflation remains a primary concern, with 56% of Americans identifying it as their biggest financial worry for 2025. The high cost of living is a significant barrier to wealth accumulation despite positive economic indicators like GDP growth and low unemployment. So basically what they're saying is people are worried. People are just scared financially that they can't afford their groceries. They can't afford what they're doing. They can't afford where they're living. And so if we're worried about how much stuff costs now as an accumulation phase when we're bringing in a paycheck, what happens to our inflation and our cost of living in a decumulation phase when we go to retire, whenever we're no longer receiving that paycheck? What kind of worries will we have then? And so that's our job as financial planners, is to really get down to the nuts and bolts of what's important to our clients, what's important to what people want to do and what their goals and needs are when they retire. What is their lifestyle? You know, everybody has a different lifestyle. Me and my wife have a different lifestyle. I like to go play golf, and my wife wants to go spoil our granddaughter. And so everybody has a different lifestyle, especially when they walk into retirement. One of the other things on that chart was at number 6 was retirement security. While about 60% of Americans have retirement savings, only half feel confident about their financial security in retirement. And anxiety over outliving savings is widespread across generations, highlighting the need for robust retirement planning. So basically, we're not taking advantage of the opportunities we have by meeting with the retirement planner, by talking to a financial advisor, and putting something in place that I know my money's going to be there and it's going to last. I recently read a report on Fox News that talked about, on average, the American will spend 2 to 3 times more planning a vacation per year than they will on their retirement plan. Now, think about this. There's a good chance that some of you out there are going to live 25 to 35 years in retirement, and we're not making those plans for that. So what happens? Are we going to run out of money? Are we going to outlive our funds? Are we going to have anything to pass down to our children? So what we want to talk about today is financial advice. And where does financial advice come from? And again, this goes back to the Caprock Blueprint to a richer, more balanced life. Is what kind of advice are you receiving and what kind of advice are you looking for? If you have some questions or concern and you just want to talk about it, give us a call, 806-749-7870. We'd love to answer any questions that you have. But the number one topic on advice is no financial advice, just nothing. I'm not doing anything. And there's 2 types of people, what I've seen in my experience when it comes to no financial advice. There's a handful of them that have been real successful. They've done a really good job. They've self-educated. They've done their homework. They've done their research. They know exactly how much money they need to live on. They understand the markets. They understand bonds. They understand annuities. And whatever investment vehicle they're doing, they've looked into it. They studied it, and they know exactly how this is going to work. And they've done a great job, and they're prepared. Whether they started at a young age, which they probably did, they started at a young age of saving, of investing, of putting money back in the market. They've done a good job, but they've educated themselves. But also at the same time, we've seen those type of people that do the no financial advice is basically put our head in the sand. They have no idea what they're going to need to retire on. They have no idea how much they have. They have no idea what it's invested in. and they're just not prepared. They have no idea how it's going to work for them. And that's a scary thought, because I've had situations where someone walks into my office and said, "Hey, I'm retiring next month. What can I do?" And that's a tough conversation when you tell somebody that there's nothing I can do to help you. This is what you have. I wish you the best of luck, and I hope it works out for you. Because there was no preparation on their part. It was just walking through life, not paying attention, not being ready to be financially independent when we go to retire, because we've gone from that accumulation phase down to the decumulation phase where I'm taking my money out. The second type of financial advice is bad financial advice. This could be a get-rich-quick scheme. And this is a big red flag where it could be a scam. It talks about fast wealth, that this is the next thing. Now, there's all kinds of things out there in this world that might be worth investing in. And if that's your play money, that's great. That's what you want to do. But if it's your retirement income and it's your retirement future, your legacy, you got to be real careful about where your money's going to be going, because you want to make sure it's going to go to somewhere or someone that you know is going to be held accountable. Now, whether that offers a return or not, I can't say that. But it's your money. But if it's play money, that's one thing, versus your retirement money, that's a whole different thing. So you just want to be real careful about bad financial advice. Something else that comes to mind when we talk about bad financial advice is taxes, tax risk when it comes to retirement. A lot of people, we always assume that when I retire, my taxes are going to go down, that my tax bill will be less. And that's not necessarily true, because there's a lot of things that go into that. It could be I lose my tax deduction. It could be some legislative risk that they've changed the tax brackets. And so you want to be real careful when it comes to retirement planning to know what my taxes are going to be. And then the second part of another part of bad financial advice is emotion over analysis. And we see this a lot when it comes to, maybe independent people. We're taking care of ourselves. I'm looking out for my stuff. The emotion that becomes involved. Just recently, the first of the year, we've been going through this tariffs, and you hear a lot of people are very, very nervous about that. But let's go back even a little bit further, back into 2008. How long ago was that? That was a long time ago, 17 years. And it seems like forever ago, because a lot of people have forgotten about it. But if you're in this retirement phase, you remember your 401ks, you remember your IRAs taking a knock. It's about a 40% loss. But when we bring in emotion of it, we work with a lot of federal employees. We've been blessed to work with a lot of federal employees across not only Texas, but the U.S. And so one of their funds, they have a thing called the TSP, Thrift Savings Plan, and it's similar to a 401k, and it gives you some certain options you can invest in. And one of those investments is called a G fund. It's a guaranteed fund, basically kind of a CD that I can't lose any value. My money's guaranteed. And it's going to earn a little bit of interest. So the G fund is pretty popular for federal employees because it's a very conservative investment. But what a lot of the stories that we heard in 2008, a lot of the things that we saw was whenever people got nervous, they switched all their money over to the G fund. So I might have been in the common stock fund, I might have been in the international fund, but at that time I got scared, my emotions took hold, and I jumped over to the G fund to protect my money. Well, the problem was we had already lost our value. We had already lost 30 or 40% of our value, and we went over to the G fund. So what happens when we do that is when the market starts to come back and it starts to rebound, we're going to miss that good growth. We're going to miss that growth potential. So an average person in 2008, where it took them about 4 to 4.5 years to recover what we lost, those people in the G fund that were very emotional about this, it took them even longer. It took them even maybe 10, 15, if they ever even got it back, because we missed the good times. Because what we've seen in the market is whenever there's something bad, most times there's going to be something good to follow. But when we let emotion get involved in it, sometimes it can take longer or maybe not even at all. And then the third type of financial advice is one-sided. And we're going to take a quick break, and I want to come back and discuss one-sided financial advice. All right, so we're back. So let's talk about one-sided financial advice and how this could be very, very detrimental to a lot of people out there. So when it comes to one-sided financial advice, one of the main things we see is failing to ask questions, not finding out what's important to the client, to the person, to the spouse, to the beneficiaries. So it's always important that we ask our clients, what's important about your money? What is the goal you want this money to do, whether it's a 401k, IRA, a non-qualified account? What do you want this money to do? Where do you want it to go? A lot of the times on one-sided financial advice, we see a push of a product or an agenda that, hey, I've got the best product. Everybody needs to be in this. This is the best thing. And it's getting worse and worse because now we have the social media. You see it on the news. You have these people coming out and they're just pushing what they want and what they think is going to be best for everybody. And my question to you is that being a fiduciary? If someone's out there and they're in the news and they're talking about, let's take, for example, there's a gentleman out there on the news. You might have seen his commercials. You might see him in magazines, but the guy hates annuities. That's his whole sales pitch is, I hate annuities. And I've seen this for years and years and years. This guy saying that I've got the best mutual funds and I hate annuities and this is what you need to do. And it's a great stick. He's done a good job with it and he's made a lot of money. But by saying I hate annuities that's a one-sided advice because sometimes annuities might be a good situation for somebody. But going back to this gentleman I hate annuities. Well, come to find out, this gentleman owned approximately $74 million worth of annuity stock or life insurance stock of a company, $74 million of an annuity company, but yet he's on the news and his marketing stick is, I hate annuities. So if annuities are so bad, why was this gentleman doing that? Why was he invested in an annuity company stock? Was it doing that well? Did he get that good of a return? But what you see a lot of the times is on these national firms are someone being one-sided, someone pushing something. You can take a look at the local news, on the business news sometimes when they're talking about, hey, you need to buy this stock, buy, or sell, sell, sell. You see that all the time. But what they never take into account is who they're talking to. Everybody's situation is different. So if I got on this show and I said, hey, I've got the perfect product for every one of you out there, and this is what y'all need to do, and you need to buy, I hope you think I'm crazy because I am. Because never as a fiduciary can you do that because everybody's situation is different. We're going to speak a lot about annuities on this because I do believe in annuities in the right situation. I believe in life insurance when it's the right situation. I believe in the market when it's the right situation. But if you have someone that's so scared of the market and they're so conservative and the last thing they want to do is lose money, should we be pushing them towards the market? No, probably not, because that's not what they're going to be comfortable with, and that doesn't match up to their goals. So every situation is different, and so that's why it's so important that you're aware of what is one-sided advice. Is a financial advisor going to get an extra commission or an extra bonus if he sells certain types of product? Does that happen? Yes, it does. That's out there. And so you have to be careful about who you're working with and what the goals of your money are. So those are the three types of bad advice, no advice or one-sided advice. But let's talk about good financial advice. It basically comes down to questions. What are your goals? Let's talk about your risk tolerance. Let's talk about your life situation. Do you have extenuating circumstances? One of the things we do here at Caprock Wealth and Wellness in our first meeting, when we meet with our clients, we call it an inspiration conversation. And basically what we do on that conversation is we get to know you. We get to talk about who you are, about what your goals are. I get to explain who I am and where I came from and my family and my lifestyle. And we get to talk about who we are and where we want to go and where we want to be. And that's the best thing in my job is I get to know people. I get to know what their goals are. And it's so, so rewarding that when I'm able to work with someone that says, these are my goals, these are my dreams, and we're able to put those goals and dreams on paper and make it make sense. We want to promote long-term thinking. We want to encourage habits like budgeting, emergency savings. We want to invest early, and we want to avoid lifestyle inflation. We want to live within our means. And that's hard to do. I grew up, my parents were farmers, and so I remember it was, we had a local banker, and so back in the day when we needed money, that we could run down to the local bank, get more money for the farm, and so that was the way I was raised, and I had to make adjustments as I got older that it doesn't work for me because I'm not a farmer. I can't run down to the local bank when it works or when I need money and grab some because it doesn't work that way anymore. We want clear, transparent, and actionable items. We want to be able to explain the why. Why do we recommend something? Why? We want to empower informed decision. We don't want to make it emotional. We want to be able to have a why of what we're doing and why I would recommend something. I want to be able to know that if I make a recommendation towards an annuity, does it make sense for this client? Does it make sense that it's going to work, and is that the best thing for them? We want to consider the numbers. We want to acknowledge psychological fears. We want to discipline, and it's not just the math. We want to use the math, but we also have to have the behavior involved. We want to talk about risk management. When we talk about the market, we look at the S&P 500, for example. So whenever we do a plan, and this is talking about the market risk, everybody has a different risk profile. I have a risk profile. My wife has a different number. You would say mine is probably going to be quite a bit higher than my wife's. She's more about security. I'm more about, hey, let's let it roll and see what happens. And so when it comes to investing, our risk profiles are going to be very different. So when it comes to investing for our clients, that is the number one thing that we have to consider when we go invest their money. When we're recommending something is, what is that risk profile? So one of the things we look at a lot is we have several different reports that we use, but one of them is a beta. So beta is, what is my reward or what is my return? So what is my risk? What kind of risk factor I'm at? And so let's say your beta is at 80. Let's say it's pretty risky. It's around 80. Well, the S&P 500 is at a 1. So 1 is a standard benchmark. That's what we all compete against, is the S&P 500. So if I'm at an 80, I'm taking about 80% risk of the market. So why is that so important? Because if I was making a recommendation for a retired person that has a risk profile, say around 30 to 40, and I'm over here recommending something that has an 80 risk profile, am I doing justice to that person? No, we're not. And so it's so important that we take care of risk management, because we want to balance the growth with protection. It's a GPS system. Growth plus protection equals success. Diversification. Do we need to use insurance? Do we have an emergency fund? It's not about just chasing the returns. It's very important that you know how your money's invested and that investment is lined up with your risk profile. And we also don't want to sell a product. This comes from certain companies that have a vested interest in pushing certain products. So you want to be real careful on what kind of products are you buying. Is it the best product out there? Does this company have good ratings? Do I know where this money is going to be and where it's going to be held? And then the most important factor of good financial advice is education. We want to teach our clients how the process and the product works. It's not just about selling something. It's not about pushing something, about what's important. Does this make sense to the client? Now, being an independent investment advisor, we're able to use multiple companies. I'm not tied to any one company. I'm not tied to any one investment. I'm able to build a holistic portfolio that's going to be best for our clients. And so that's where we take out the one-sided advice. That's where we take out the bad advice, because we want to be a holistic financial planner that takes all of our clients' considerations, their needs, their goals, and we put them into a formula that's going to build something for them. Not for me. It's going to be for them. And so that's where it comes in, being a fiduciary is, it says I have to put my client's best needs forward. It's not about what I want, it's about what my client wants. And so that's very important for us here at Caprock. So let's take a quick break. We're going to come back and we're going to touch some more on good financial advice. Okay, welcome back. Again, this is Caprock Wealth and Wellness, and I am Dereck Blair with Caprock Financial Group. And if you have any questions, our office number is 806-749-7870. And this is the Caprock Blueprint to a richer, more balanced life. So earlier I was talking about kind of going down that rabbit hole of Google and just searching some different things. And, I got to looking at financial advice, and I was looking at what are Americans concerned about. And then I jumped into risk in retirement. So when someone's in their retirement, what are the stresses for them? What do they stress about? And number one on that chart was the longevity risk. This is basically just outliving your money. It is that I am not going to have enough money to last. And there's a lot of misconceptions out there from what you see and what you read about what is that number that you have to have. You see anywhere from you have to have $1 million, you have to have $2 million to retire comfortably. And that's crazy because everybody's situation is different. Not everybody is going to live some crazy lifestyle where they're going to buy a new car every year. They're going to travel all the time. A lot of people are just happy, taking care of their grandkids. And so that's why that number is different for everybody. What one person's $1 million might be someone else's $500,000. And so it's real important that you talk to a professional about how is my money going to work for me and is it going to last? And so you just want to plan your lifetime income strategies. There is a good chance you're going to live 25 to 35 years in retirement. And so you do want to make that money last, but you want to be efficient in how you're going to take it and where you're going to take it from. That second major risk of retirement was the market risk. And that is a big one because of market volatility. Market volatility is big. It can change the way you take your money. It can change the way you pass your money to your beneficiaries. But you have to know what your risk profile is. How much am I willing to risk in a certain type of investment, whether it's the S&P 500, the NASDAQ, a life cycle investment fund that as I get closer to retirement, that it's going to become more conservative. So you have to know what that risk profile is going to be because it's different for everybody. And so you just want to know what yours is going to be. You want to look at the portfolio. Are you diversified? Or is there some risk management at play? So you just want to be real careful in your decumulation phase of when I'm taking my money out for retirement. Am I invested the best way that I can be? The third one was healthcare and long-term care risk. And this is a big one. Healthcare with inflation is drastically driving those costs up. I did last June 24, I had a total hip. And I want to say that bill was right about $80,000 for a total hip. And so I know that's drastically going up and it's only going to go up even more just with the cost of healthcare. And so that definitely outpaces inflation. So we have to know kind of healthcare wise, are we financially going to be able to take care of ourselves? Are we going to be able to pay for the things that we need moving forward? And I think, and I'm not trying to be political, but it seems like you have an administration that's really trying to do some good things when it comes to healthcare costs, such as pharmaceuticals, trying to get those prices down because hopefully they realize how important that is for, our retirees or soon to be retirees, how important it is for that to go down because inflation on those prices are really going to eat us up when it comes to that. The second part of that is the long-term care risk. And I've said this before, but if you're a healthy person, age 65, there's a 74% chance you're going to need long-term care. And so that means there's a 26% chance you won't. So I'm a big believer in that I don't want to put an investment into something I'm not going to get a return on. And so I don't want to pay for long-term care if I know I'm not going to need it. And so that's kind of like a magic 8-ball of, am I going to need long-term care? Well, we don't know. Nobody knows. I was blessed that I had 4 on my grandparents, my mom and my dad's parents. None of them needed long-term care. But when you look at my wife's side, several of her grandparents needed long-term care, and that came into effect. And so it was real important that they had that. So long-term care is just real important that you have a plan in place of how is it going to be used? What am I going to use? Where's that money going to come from? And what we're seeing is our companies are getting smarter. Our insurance companies are getting smarter, whether it's life insurance or annuity products. Like on the life insurance side, a lot of the carriers that we have now on the life insurance, that death benefit is also a long-term care benefit. So if I have someone that, has $1 million death benefit and they needed long-term care, they qualify for 2 out of the 6 activities of daily living. They can't bathe themselves, they can't feed themselves, they can't get dressed. Well, all of a sudden that death benefit can be used for a long-term care benefit, whether that's going to a facility, whether it's having a nurse come to our home. We just know that person's going to be taken care of and we're not having to pay extra for it. So the companies have done a real good job about looking out for their clients and getting a whole lot smarter about that, because we do know that long-term care costs are on the rise and they're only going to continue to rise. So it's real important that we kind of take care of long-term care risk. And again, that goes back to holistic planning, that's part of the process. And then the fourth risk is inflation and purchasing power. And we've talked about this before. Low inflation, even low inflation erodes fixed incomes over time. So if I'm bringing in, if I go to retire and I'm bringing in $5,000 a month right now, man, I could be real comfortable. I could still go and do what I want to do. I go out to eat a couple of times a week. I'm enjoying my retirement. But what I care about is that $5,000 today still going to take care of me in 5, 10, 15, 20 years from now? Is my lifestyle still going to be there? And more than likely, if I have a level payout, which means I get $5,000 today, I'll get it $5,000 for the rest of my life every month. Is that going to be comfortable for me? There's a good chance it won't. So we have to have some things in place that are going to help me with the inflation. Do I need to use the market? Is there a certain type of product out there that's going to give me some growth protection inside of my income that's going to compete with inflation? And those things are very, very important because we see what inflation does. I've said it before that, me and my wife, we have 6 kids. And, 10 years ago, for what we paid for groceries, we could feed all 8 of us in the house. Well, now we're down to 2, and I'm still paying those same amount of groceries for just us 4 in the house because that's how much the groceries have gone up, and that's how much they've increased. So that's something that's real important as you walk into retirement is to be prepared for inflation. My purchasing power has to stay strong. Are my assets growing? Do I have some inflation-adjusted income strategies? They're so essential, and so it's real important that we're looking out for things like that. And then on the last one for major risk of retirement, it talks about policy and tax risk. And this is real important to us here at Caprock Financial Group is tax risk, because everything you do in retirement with your 401k, your IRAs, any type of qualified account you have a silent partner. And I know it doesn't feel like it now, but we're at historically low tax rates. So right now we are in a controlled environment. And they're trying to pass this big, beautiful bill, and I know it's in the Senate, and that's what they're trying to get passed. And they want to keep these tax rates right now, Trump's tax codes, we want to keep those going a few more years is what they're trying to do. They're trying to make them permanent, not being political, not sure if it's going to happen. But the reason we like those are because we know what kind of tax environment we're in. And so as we build a plan for our clients, if we're heavy into qualified money and we're looking at doing in some conversions, we're looking at converting some of that qualified money over to tax-free vehicles, we know what kind of taxes we're going to pay. As a financial advisor, it's hard when we don't know what that next step is going to be and how much those taxes are going to be in the future. So again, I appreciate you taking your time to listen to us this morning. Next week, we're really going to dive into some policy and tax risk. I'm really excited to talk about this because this is what we've been working on the last couple of weeks with some different the seminars that I've been to, some different organizations I've worked with about policy and tax risk and how it's going to affect our retirement. So that's what we're going to be talking about next week. Again, I appreciate your time. I hope everybody has a wonderful day today and look forward to talking to you next week. Thank y'all.